Hello guys and welcome back. There are three stocks I want to show you today that are excellent dividend growth stocks here in the UK that offer massive growth on regular payments every quarter. Now these companies may not offer the high starting yield that we may see with other dividends. However, they make up for it with a history of increasing dividend growth over the past 20 years or so and safety and reliability when it comes to those dividends. All of these stocks have been raising their dividends for the past 20 years and are British companies with competitive margins. I'll be showing you guys these companies, their financials, including their dividend safety and growth, followed by valuations and fair buying prices for these stocks. As always guys, if you like this sort of content and want to see more just like it, then feel free to subscribe to the channel. The first company is a leading global financial markets infrastructure and data provider. At a share price at around £92, this one has returned over 8% in the past year and over 70% in the past 5 years on just share price appreciation alone. When looking at dividend growth stocks, investors should really consider the nature of the business that they're actually investing in. Is it a highly cyclical business like oil or car manufacturing that can cut those dividends and cause their management to not even maybe pay out on those dividends? Companies like BP, for example, offer good starting dividend yields, however can cut them drastically when those yields are not really reflective of the profits that this company is receiving due to the nature of oil prices. That's the opposite of the London Stock Exchange PLC company, which is highly margined with 84% growth revenue margins. It's a consistent business that owns European leading stock exchange, offering index funds like the FTSE 100 and the FTSE 250. Additionally, they run analytics, risk and capital markets business segments. In terms of how they've been performing, they've grown revenue consistently, if a little bit slowly, in recent years, producing £8.4 billion in December 2023 for revenue. When we compare that to the free cash flow figures that we're seeing for this company, over the past 5 years they've grown very well. In 2020 they were sitting at 800 million. And now we're sitting at 1.9 billion, a bit flat for the past 3 years, but still has a 3-year CAGR in growth of free cash flow of 34%, which is really nice to see. Now we compare this to their debt position and it's substantial but low enough that in a year and a half the company could pay it all off. And finally, their dividend safety, which is not really available but is well covered by free cash flow with a payout ratio of 34%. So if you ask me, it's very safe. And they've stuck with that for the past 5 years. With a yield of 1.07%, it doesn't pay the highest dividend yield to start with, but offers a great growth rate, growing 17% in the last 20 years and 14% in the past 5 years. Which is impressive if you ask me for a UK company with no cuts in the past 20 years or so. Although it's worth noting that this one pays out semi-annually, so effectively you won't be getting it every quarter. So is this company at a buy right now? Well, Wall Street have a 12-month price target that's averaged out at about £107.60, representing 18% upside from the current share price. And Morningstar fair value sits at £98 per share, so which could mean it's fairly valued right now and may present a buyer opportunity. The second company is an excellent business that's had a massive run up in share price over the years, up 48% for this year and 190% up in the past 5 years just on share price appreciation, and has a dividend starting yield at 2.02%, which is obviously quite a bit higher than LSEG. This systems and aerospace manufacturer offers an end-to-end innovative design, manufacture, maintenance and upgrading of equipment and systems used mainly by military personnel and defence staff all over the world. This company produces munitions and amazing technology for land, sea, air and space, including next generation Bradleys and the F-35 model aircraft. This has benefited them quite well in terms of financials, with revenue having steady increases per year, up 7% year over year for the past 5 years, to £23.1 billion. Now, if we compare that to their bottom line, net income, that has seen greater increases as margins improve, with a 13% CAGR in net income for the past 5 years to £1.9 billion. They could pay off all of their debt in less than a year as well, showing very few issues with their debt position. And then we have one of the best metrics for this company, in my opinion, with 48% 3-year CAGR of operating cash flow growth, taking us to a sum of £3.6 billion, which is really impressive growth. A large amount of which is used to invest back into the company and to grow that dividend. The dividend growth, on the other hand, of this company is consistent and seems to be growing at quicker rates, with 11% increase this year and a 6% CAGR over the past 5 years. So it seems to be rapidly increasing those margins. All of which translates to a sort of stronger balance sheet and fast growing dividend, which is also paid out semi-annually. Unfortunately, this one isn't a quarter payer as well. Now, in terms of valuation for BAE Systems, it's had a very high share price run-up, so let's see what it's really trading for now. Wall Street have an average price target around £14.19, which only shows about a 2 to 3% upside from the current share price we're seeing. However, they have a higher price target, which shows 21% upside at £16.80, which could be more appropriate if past performance is anything to go by. As well as that, we've got Morningstar, which has upgraded this one recently in fair value to £14.90, higher than the current share price due to a number of factors, including higher spending in defence budget in European countries. So it's arguably fairly valued at the moment, despite that impressive run-up. So we could see more share price appreciation in the coming years. Finally, we have a stock that I've talked about before, but I couldn't help but mention again, which is an excellent analytics company based out of the UK with a stellar track record of dividend growth. And if you've liked these sort of stocks and want to see more just like them, then feel free to subscribe to the channel and like the video. This one is RELX, a risk and analytics data provider with a grand run-up in share price appreciation over the past year, up 37%. For this year alone, and over the past 5 years up around 87%. So this takes us to a share price of £35.21. As with most analytics company, this company offers information-based decision tools and analytics to business and individuals. This company is similar to London Stock Exchange PLC, with its very good margins, making it highly profitable from its revenue sources at over 64% gross margins compared to the industry average of 42%. The revenue segments themselves are fairly complex, but incorporate all different types of legal, risk, insurance, and academic research analysis. The most prominent sort of form of revenue they do have, which is risk assessments of their business services and insurance, which takes up quite a bit of chunk of that revenue. The company offers high costs for clients to change away, like providers away from LX, and has an excellent reputation with its clients to keep them paying regularly to use RELX's service. Their financials over an excellent 9% growth CAGR in terms of revenue over the past 3 years, producing £9.2 billion. And the bottom line net income has seen even better growth at 13% CAGR in the past 3 years to £1.8 billion, which shows an increase in profitability and growth in more recent years. So they hold around £155 million in terms of cash and equivalents, which isn't that much, and it's very small when compared to their debt position. But with how much they produce per year, they could actually pay off this debt position in under 2 years if the company wanted to. So then we've got their operating cash flow, which has shown great growth, with those revenue and net income numbers up 15% in the past 5 years, bringing us to £2.5 billion. And then finally, we have to consider their dividend, which is highly predictable and growing, with RELX offering a yield of 1.68%, rated 67 in terms of safety. Now, the reason it's included in the dividend growth stocks is that it has 13 years consecutive dividend growth in the past, up 8% in the last year, and has a CAGR of growth in the 7% range in the past 5 years. Now, the dividend is well covered by the free cash flow payout ratio. As we can see here, it sits about 48%. Now, one of the other great things I like about this company in particular is its share buybacks, which they do fairly good rate, sitting at 1.9 billion shares now, and they had about 2.1 billion back in 2015. Now, if we look at the valuation on RELX, we can see a low forecast for this stock at £33.33, which shows about a 3% downside from the current price. Then we have £38.04, which is an average forecast, which shows 11% upside from the current share price. And finally, a high forecast of about 28% in the green, with £43.72. Which all seems to line up with actually Morningstar's fair value for this one, which sits at around about £36.50. So effectively, this one could maybe offer a fair valuation at the current share price, which is around £34.50. So it might be one to pick up. Well, there you go. All these stocks have high dividend growth rates for UK-based companies, if you ask me, even if they don't have the highest starting yield. Additionally to that, they're in non-cyclical cycles of business that are reliable and probably where we should look to maybe invest as investors. But what do you guys think? Do you like these businesses? Are you looking to add any? Let me know down below. And if you wanted to catch my more recent buys in my stock portfolio, then feel free to check out my latest video. As always, guys, thanks for watching. I appreciate it, and I'll see you in the next one.